Look at the skyline of any major American city. What you see isn't real estate anymore. It's a tomb. For decades, these towers were the ultimate collateral, the safe bet for regional banks and pension funds. But in February 2026, the concrete is rotting from the inside. We aren't just talking about empty desks, we are talking about a $1.5 trillion debt wall that is currently collapsing onto the balance sheets of the banks that hold your deposits. Most people think the banking crisis ended with Silicon Valley Bank in 2023. They are wrong. That was the tremor. This is the earthquake. The lights are on in these buildings, but the value has already checked out. Welcome to the Dossier. To understand the crash, you have to understand the maturity wall. In commercial real estate, loans aren't like your 30-year fixed mortgage. They are 5 to 10-year balloon loans. Between now and the end of 2026, over $1.5 trillion of this debt must be refinanced. Here's the math that the mainstream media ignores. These loans were signed in 2016 or early 2021 when interest rates were near zero. Today, even with the Federal Reserve's recent attempts to stabilize the market, the cost of capital has effectively doubled. Imagine you are a property developer. You own an office tower that is 20% empty, and your interest payments just tripled. You don't refinance, you default, you hand the keys to the bank and walk away. This isn't a theory, it's a mathematical certainty. When the price of money changes, the value of the asset it bought must die. We are witnessing the largest repricing of commercial assets in human history, and it is happening in real time. But there is a darker layer to this mechanism, what we call shadow vacancy. Official reports say office vacancy is at a 40-year high of 20.1%, but that number is a lie. It only counts leases that have already expired. Shadow vacancy refers to the millions of square feet currently under lease where the offices are physically empty. Companies are waiting for their contracts to die so they can downsize or vanish. This means the doom loop is actually much deeper than the charts show. Landlords are using zombie leases to keep their valuations artificially high so they don't trigger a margin call from their lenders. But the clock is ticking. As these shadow leases expire throughout 2026, the ghost inventory will hit the market all at once, leading to a catastrophic supply shock that will send valuations into a terminal tailspin. Why aren't the too-big-to-fail giants like JP Morgan panicking yet? Because they aren't the ones holding the bag. The heavy lifting, roughly 70% of all commercial property loans, is done by small and regional banks. For these lenders, commercial real estate isn't just a part of their portfolio. For some, it represents over 44% of their total assets. When an office tower in Austin or San Francisco loses 50% of its value, which is happening right now, it wipes out the bank's capital buffer instantly. This triggers the urban doom loop. Falling valuations lead to bank losses, which lead to tighter lending, which starves local businesses, which further destroys the city's tax base. It's a self-reinforcing cycle of insolvency. If the bank can't sell the building and the landlord can't pay the loan, the bank dies. And in 2026, we are running out of white knight buyers to save them. Do not be fooled into thinking this is just an American problem. The contagion is already crossing the Atlantic. Our data shows that European banks, particularly in Germany and the UK, are heavily exposed to US commercial debt. We are seeing the Japan trap logic apply here as well. Global liquidity is shrinking, and as US property values crater, it creates a hole in the balance sheets of institutions from Frankfurt to Toronto. This is why we saw record volatility in European bank stocks this quarter. The interconnectedness of the 2026 financial system means that an empty tower in Chicago is effectively a liability for a pensioner in Munich. It is a global margin call. The bail-in shadow is growing. Governments are already preparing orderly liquidation protocols. Translated from bureaucratic speak, that means your deposits and your purchasing power are the collateral of last resort. The twist is that this isn't just a financial crisis, it's a civilizational shift. The central business district model is dead. The tax revenue that funded police, schools, and infrastructure is evaporating along with the office valuations. As cities become more expensive and less safe, the exodus accelerates. The government's only remaining move is currency debasement. They will print the liquidity needed to prevent a total systemic collapse. But in doing so, they will sacrifice the value of the currency in your pocket. They will save the banks by destroying the dollar. You will see the headlines calling it quantitative support or market stabilization. But the reality is simple. They are inflating away the debt of the elite by devaluing the labor of the many. The window to ignore this is closed. 2026 is the year of the slow-motion car crash. While the gurus on social media talk about a cautious recovery, the smart money, the 1%, is moving into assets that exist outside of the regional banking ledger. Physical gold, silver, strategic land, and decentralized networks like Bitcoin. Most people will watch this video and do nothing. They will wait for CNN or the BBC to tell them it's a crisis. By then, the exits will be jammed and the bail-in laws will be in effect. Don't be a statistic in the urban doom loop. This channel doesn't trade in hope. We trade in intelligence. If you want to survive the 2026 liquidation, you need to be positioned before the headlines scream the truth. Subscribe to the Dossier, secure your bunker. I'll see you in the next briefing.